Hello, everyone, and thank you for joining us today. Before we dive into our presentation, let's warm up with a little tax brain teaser about Bill. After working hard for his entire adult life, our good friend Bill, a music lover, is now 65 years old. He's finally retired, and he's going to more concerts than ever before. Bill has $42,275 in taxable income, which you can see on that chart, which includes $25,000 of Social Security benefits this year. As you can see, Bill's $42,275 of taxable income puts him in the 22% tax bracket. That's because it's more than $41,775 and less than $89,076. Toward the end of the year, Bill decides that he wants to take an extra $1,000 out of his IRA for a trip to go see Adele play in Las Vegas. How much is he taxed on that extra $1,000? The logical answer, of course, is that for every dollar of IRA money he pulls out, he should pay 22 cents in federal income tax. Therefore, if he took out $1,000, he should owe $220 in federal income tax, 22%, right? Well, as you probably guessed, it could not be that easy. The answer is that he actually owes $407 in tax. That's a 40.7% federal tax rate on that income. Thanks to the unique formula that determines how your Social Security benefits are taxed, the real answer is that Bill owes $407 on that extra income. Before I get into how this happened, please welcome the founder and CEO of Advisory Group West, Mr. Bob Donaldson.
Well, hello, everyone, and welcome to part one of today's presentation, How Tax Planning Changes Through 4 Stages of Retirement. As Derek mentioned, my name is Bob Donaldson. I'm a chartered financial consultant and CEO of Advisory Group West. You'll see today's agenda on the right-hand side of your screen in the handouts section. Today's presentation is educational in nature, not a sales pitch. It's intended to raise your level of awareness about income tax reduction throughout your 4 stages of retirement. Once completed, you should be better prepared to address the challenges of retirement tax planning. Before we begin, I'd like to go over briefly some housekeeping items. You'll see a Q&A tab on the right side of your screen. At any time during the webinar, you can send a question or comment in that box. Your comments will remain private and can only be viewed by today's presenter. Also, throughout the presentation, we will be taking several polling questions and, of course, encourage your feedback. Lastly, throughout the webinar, you will have an opportunity to schedule a complimentary conversation with us here at Advisory Group West. Advisory Group West is an independent, registered investment advisory firm. We have access to almost all investment products or services that clients may need, but we have no proprietary products. We only work for you, not the wirehouses or the insurance companies or the annuity companies. What that means to you is that we have no axe to grind. We're here to represent clients' best interests. Now, in an effort to respect everyone's time, we will be stopping promptly at 45 minutes. Your presenter will do his best to address all questions that are asked, but if we do not get to your particular question, we promise to follow up with you and address it privately. With those few housekeeping items covered, I'd like to introduce you to your speaker. Mr. Derek McLaughlin is a certified financial planner. He's been working in the financial services for over 20 years. He has been with Advisory Group West for over 11 years. He earned his BA at California State University, Los Angeles. Please help me welcome your presenter, Mr. Derek McLaughlin.
Hello, ladies and gentlemen. Very nice to meet you. Usually for the first 9 months of the year here at Advisory Group West, we present workshops and classes on various financial educational topics, such as Social Security, estate planning, IRA planning, healthcare planning, cybersecurity, investment planning, college planning, and many other topics. Our goal always is to inform and educate our audience so you can understand how these critical financial planning topics affect you and your family. We do these presentations because we've seen many people make avoidable mistakes in retirement. When that happens, it puts undue stress on you and your assets. we can help you to avoid some of those mistakes. Speaking of our workshops, Bob, who you just met, he did a fantastic presentation on estate planning last month. If you'd be interested, just keep your eye open and we'll be doing more throughout the year. I want to mention that at the end of today's talk, we will invite you to attend part 2 of this presentation, where we will address all of your questions personally. This is a complimentary one-on-one conversation that we offer so that we can discuss in private the issues raised by tonight's presentation. If you'd like, you can click this pop-up box here to schedule your appointment now. I'll tell you more about that later. Now, there is one other important point I need to make. Everyone's tax situation is different. Taxes can be complex and full of jargon. Typically, the underlying concepts are pretty straightforward, but with over 2,600 pages of tax code, it takes more than just a few minutes on April 14th to sort it out. So you should always consult a qualified professional tax advisor to discuss your specific tax situation, especially around topics such as traditional IRAs. These are tax-deferred accounts where you must pay taxes on distributions or conversions at your ordinary federal and state rates. Of course, that tax is on top of your Social Security, pension, rental income, and many other sources. Roth IRAs, here you do not get a tax deduction when you put the money in, but the account grows tax-free. Principal and earnings may be withdrawn tax-free in accordance with IRS rules. Careful though, there are a few catches that can make you end up paying tax on the earnings if you're not careful. State taxes, this presentation is all about federal tax. You may still face state taxes though, and unless you happen to live in one of the 8 states that do not levy a state income tax, that is, you may save on income tax there, but most of these other states, they will find other creative ways to get you. So please check with your tax professional. We at Advisor Group West are financial planners. Legally, we cannot provide tax advice. What we can do is we can help people understand how the tax code and other rules can impact their financial planning and investments. Then we develop a plan to take into account the many of the odd things that people encounter, especially around taxes and retirement. The next time you go into your CPA's office, you're going to be well prepared. And instead of reactively trying to figure out how to pay less in taxes, you will have already proactively worked on solutions to reduce your tax liability. So chances are you've already been working 30, 40, maybe even over 50 years now, and you've gotten fantastic at what we here call the accumulation phase of your life. You saved, you sacrificed, you contributed to that 401k, you bought those homes, put your kids through college, and I hope that you've watched everyone and everything in your life grow. And now you're likely at or near the phase of your life where you do a 180 and you're no longer accumulating assets, and instead you start to depend on those assets for the rest of your life. We are here to help you demystify what we call the distribution phase of your life. This period is much different than the accumulation phase that you are so used to and you've become so good at. During this distribution phase, you are depending on what you have built to maintain you for the next 30 or 40 years. And this phase has new, strange rules that can catch people off guard. Along with these new rules, there are often many changes in your own personal life that can have a big impact on your taxes. Think about it, for instance, if your children are grown, that means no more child tax credits. Your house may be fully paid off, and that means no more mortgage interest deduction. If you've already retired, you may no longer be receiving tax-free employer-paid medical insurance. If you've stopped working, you may no longer have the ability to manage your annual tax bill by stashing away some income in a 401k or a similar plan. And at some point, you may have to start taking Social Security. And of that benefit, either 0, 15%, or 85% is going to be taxable. And sooner or later, you will be required to start taking minimum distributions from your retirement accounts. Those are known as RMDs. And by the way, did you know that they very recently changed the RMD age from 70 and a half to 72? that means you have an extra year and a half where you're not forced to start taking fully taxable distributions. The list of changes during your retirement phase goes on, and many aspects of retirement will affect your tax bill in ways totally different from your working years. Understanding what these are and how they can impact you is crucial. Okay, so what's the first thing you need to understand about taxes in retirement? You have to know what your after-tax retirement picture looks like before you actually retire. So let's use this opportunity here to do our first poll of the day. What process do you use to reduce your taxes? I don't have one. I do it when I meet with my CPA to file last year's return, or I proactively plan to reduce future income taxes. And by this last one, we mean that it's you sit down with your financial advisor or your tax advisor yearly to review your cash flows and your assets. It's a proactive approach. Okay, so I'll just wait for everybody. Looks like most of the respondees here either don't have a plan or they take a reactive approach versus a proactive one. So that's normal. What we found is that having a proactive place in plan is the best way to reduce your tax bill. By the way, the response, I don't have a plan, is very common, and it's nothing to be ashamed of. As the old saying goes, what's the best time to plant a tree? 20 years ago. But what's the second best time to plant a tree? Right now. Okay. Now, for instance, a $500,000 401k or IRA balance isn't really $500,000. The government already has dibs on part of that money because the taxes were deferred when you made the contributions. They'll get their share when you're forced to start those required minimum distributions that we talked about earlier after you turn 72. So obviously, the higher your tax rate in retirement, the less your account is actually going to be worth. Quickly here on this chart, you can see how a $500,000 IRA earning 6% per year at various tax rates depletes over time with minimum distributions. As you can see, if you follow that gray line on the top, that's the mythical 0% tax rate. The lower your tax rate, the more you get to keep over time. And below that line, we have the 12% tax rate, and then lower still, the 33% tax rate. So this is simple in theory, but it's difficult in practice. Here you may be thinking, okay, my accounts may not be worth as much as I thought, but I will have a steady flow of benefits from Social Security to supplement my income, and I'll have Medicare to pay my healthcare costs. But one thing you need to understand when you're creating your retirement tax strategy is Social Security and Medicare have their own tax traps that you need to plan for. All right, so we're going to go back to our good friend Bill now from earlier, from our tax brain teaser. We want to understand why did Bill pay such a high tax rate on the extra money that he took from his IRA to go to that concert? Remember, Bill has $38,000 of IRA income and $25,000 of Social Security benefits to help make up his adjusted gross income of $56,525. That puts him squarely in the 22% tax bracket. You'll also notice that instead of itemizing, he takes the standard deduction. Yet when he took that extra $1,000 IRA distribution, he got hit with nearly 41% marginal tax rate, $407. So let's break down how this actually happens. Now, first, let's remember the only difference between our two scenarios here is that Bill has taken an additional $1,000 from an IRA. And you can see that in the after concert trip column. So here he has $39,000 in IRA income. So we see here that by adding that additional $1,000 of income, it increased both his AGI and his taxable income by $1,850. That means for every dollar of income he actually received, he's being taxed on $1.85. Why is that? Here's the deal. Depending on how much other income you have, the taxable amount of your Social Security benefit will vary. For instance, if your income is low enough, All of your Social Security benefits will be income tax-free at the federal level. On the other hand, if your income is high enough, up to 85% of your Social Security benefits can and will be taxed at whatever your personal rate is. Bill finds himself in the latter scenario now. At his current income, after the concert trip, for every dollar that he takes out of his IRA, he not only adds $1 of IRA money to his taxable income, but he must now also add an additional 85 cents of newly taxable Social Security benefits. If we add that up, that's $1.85 taxable at his 22% tax rate for every $1 of additional IRA income that he received. If you do the math on that, that comes out to 40.7% real tax rate on the additional $1,000 of income. This is the so-called Social Security tax torpedo. It can impact single filers, married couples, and even people with fairly modest income during any stage of retirement. It's one reason why planning for these taxes is so important. Now let's talk a little bit about Medicare and taxes. We're going to take a look at how Medicare and something it calls IRMA can impact some couples in their early retirement years and beyond. IRMA stands for Income-Related Monthly Adjustment Amount. Now that's a mouthful, but the emphasis here is on the word income. IRMA is a tiered surcharge. We consider that a kind of tax, paid monthly, that is tacked onto Medicare's Part B and D premiums. But it only happens if you have income over $91,000 for singles and $182,000 for married couples. So let's take a look at what that means in action. I want you to meet George and Martha. They're a high-earning married couple. They're both Medicare Part B and D participants. And right now we're looking at the year 2022, but IRMA surcharges look back at your income from 2 years ago. So if we look back 2 years ago to 2020, we can see that this couple was on track to earn $283,500 of modified adjusted gross income. That's MAGI. And remember, your modified adjusted gross income is different from your regular adjusted gross income. In December 2020, George decided he wanted to sell a stock that he originally bought for $10,000 in 2007. He sold that stock for $11,000. And the resulting $1,000 of gain was taxed at the 15% capital gains tax rate. And because they're high earners, an additional 3.8% net investment income surtax for a total federal tax bill of 18.8%. That 3.8% net investment income surtax is another tax that comes into play when your MAGI exceeds $200,000 for singles and $250,000 for married couples. Now, George and Martha owe $188 of tax on the gain from their sale of the stock. That's 18.8% of 1,000, right? Well, remember, our definition of a tax is any cost that increases as your income increases. So then George and Martha will owe more tax than the $188 because the gain from the sale of the stock pushed them off of the IRMA cliff and into paying higher Medicare premiums. Let's take a look. This Part B IRMA chart here shows us that the extra $1,000 gain pushed their AGI into the next premium tier that starts with $284,001. So now, instead of owing $340 each for their monthly Medicare Part B premiums, George and Martha will owe $442 per month. That's an extra $102 per month times 2 for an annual total increase in Medicare Part B premiums of $2,450. But it's not over because Medicare Part D IRMA charges are also impacted. George and Martha will each owe about another $19 per month for their drug plans. That's an extra $466 for the couple over the course of a year. Now, if we add up all of the IRMA surcharges for the year, George and Martha will each owe about an extra $121 a month or close to $3,000 more for the year. So if we combine that amount with the 188 of actual federal income tax that they would owe on the stock sale and the total tax owed, then the total tax owed on the $1,000 of gain actually comes out to a little over $3,000. Actually, a little over $3,100. That's a tax rate of 310%. Again, that's 310% on that $1,000 of capital gain. So to quickly review here, they sold stock for $1,000 income gain. The stock sale tax was $188. The extra income from the stock sale triggered a new IRMA tier. The total IRMA surcharges for the year amounted to $2,916 for George and Martha. So the $1,000 extra income triggered taxes of $3,104, a 310% real tax rate. So you see that being pushed into a higher Medicare Part B and D premium range is actually worse than being pushed into a higher tax bracket. That's because if you go over a regular tax bracket by even a single dollar, only that last dollar is actually taxed at the highest tax rate. But if you go over the Medicare Part B and D income levels by even a single dollar, you move into the next premium tier. And it doesn't matter if you exceed the limit by $1 or $10,000, and that's why they call it the IRMA cliff. Now keep in mind, your IRMA payments are not determined by how much money you made the previous year, but rather your MAGI from 2 years ago. It's another tax thing that catches people by surprise and needs planning. Making sure that you enroll in Medicare at the right time is a critical decision. If you miss the deadline, you'll get hit by a lifelong penalty. To help you understand, I want you to meet Jim and Ann. They're both 68. Jim retired at 65 and Ann retired at 66. While she was working, Ann and Jim were both covered under her employer-provided health benefits. And after Ann retired, those same health benefits were extended to cover both Jim and Ann for the rest of their lives. Now, unfortunately, Ann and James did not know that they had to enroll in Medicare Part B as soon as Ann retired. Well, even though Ann's employer offers retiree health insurance benefits, those benefits are generally paid secondary to Medicare after retirement. Jim and Ann did not realize the mistake until it was too late, and thanks to the way that Medicare enrollment periods work, that means they were not able to begin coverage until the next year. In a worst case scenario, this could have resulted in a gap in coverage for Jim and Ann if they'd had a major medical need. But even in a best case scenario, because Jim and Ann missed that deadline, they will each owe a 10% Medicare Part B base premium penalty for life. So you can see how much that translates to in real dollars here. They owe $408 extra in 2022. And historically, we can estimate that the premiums will increase. So that 10% penalty will continue to grow and grow along with that premium. Over the course of a lifetime, that could translate into a $10,000 mistake for the couple. And here we're assuming that Ann's retiree health insurance covers prescription drugs, so they don't have to sign up for Part D. And just know there is also a penalty for that as well. Well, we've seen how Social Security and Medicare have their own tax traps, and unique rules and penalties. And so if you're like some others who've seen this presentation before, you may be wondering what other tax traps you could face in retirement. The rest of what we'll cover isn't like what we've seen with the Social Security tax torpedo or the Medicare IRMA cliff. The public generally isn't aware of those tax squeezes. What we're going to see now is how the tax code, in plain view, snags retirees, especially when there's no planning. And speaking of having a plan, I'd like to remind you that you can take advantage of our complimentary one-on-one conversation to help you address your retirement planning and related tax issues. That brings us to our next slide. You must plan how and when you'll use taxable, tax-deferred, and tax-free assets so you can manage your income and your tax brackets efficiently. You can't be haphazard about tapping into your tax-deferred savings. Timing is everything, and if you don't plan carefully through all the various stages of retirement, you'll encounter unintended tax consequences. This brings us to our second poll of the day. How confident are you that you won't run out of money in retirement? Not confident? I'm somewhat confident, but I need some reassurance. Or I'm very confident, but I would like to be more tax efficient. Thank you. It looks like almost everybody has answered here. We have a few who are confident, but the majority are not confident or they're looking for reassurance. Reminds me of a question that we get here very often when we're doing retirement planning. People ask, what accounts should we spend first? Now, having a plan in place for how you will spend on your retirement assets tax efficiently can increase the longevity of your retirement funds. Let's explore that a little bit now. One way to help manage your income both before and during retirement is to utilize Roth IRA conversions. A Roth IRA conversion is a simple process that allows you to move money from an IRA or another pre-tax retirement account, like a 401k, into a Roth IRA. In general, the amount that you convert is added to your income for the year and will be taxed at your personal tax rate. Now, for example, if Jill converts $100,000 from her IRA to a Roth IRA, she will have to add that $100,000 to her income. That conversion income will be taxed at Jill's individual tax rate. Now, she's just added $100,000 of taxable income on top of all of her other income sources for the year. And this is a good reason why we recommend that prior to making any conversion, you consult with your tax professional. Now, a conversion doesn't need to be all or nothing. One helpful conversion approach is called filling up the tax bracket. Often you may find yourself in the middle of one of these tax brackets with some room to add room to add more income without pushing yourself into a higher tax bracket. So for example, in 2022, the 22% tax bracket for married couples filing a joint return goes from about $83,550 to about $178,000. So if you file a joint return and your taxable income is $100,000, that means you could add another $78,000 of income without going into the next tax bracket. In that case, making a Roth IRA conversion could make sense. Now, if you plan to convert a large IRA, this approach is often more tax efficient than converting the full amount in 1 year. Instead, what you do is you make smaller batches of Roth IRA conversions over a number of years, filling up your tax bracket each time. This can help reduce the average tax rate you'll pay on your converted money, and it also spreads the tax bill out over a longer period. Some tactics you can use in managing your income around tax brackets might include withdrawing tax-free money from life insurance policies to keep income low, selling highly appreciated stock for low or no capital gains, or taking conversions from an IRA or 401k to take advantage of a lower tax rate. And as we've seen, you can also consider partial Roth conversions to fill up these lower tax brackets. There are also 2 other pre-retirement strategies to consider, but they don't apply to everybody. The first has to do with how you use a health savings account. This would only apply to people who are covered by a high deductible healthcare plan. The second has to do with small business owners. Those who want to be extra tax savvy in saving for retirement, they can fund a company pension plan, which for certain high earning business owners can increase their ability to claim the qualified business income deduction. That's the QBI. Both of these features of the tax code could be used to manage your tax exposure and provide significant tax-favored benefits throughout your retirement. Now, if either or both of these apply to you, please go ahead and note that in the Q&A tab, and we can discuss that later. We've seen throughout the presentation the critical importance of managing your tax-deferred accounts. Once you're over 72 years old, you're forced to start taking out required minimum distributions, or RMDs, and that can be troublesome to your tax bill. Now, many people make charitable donations because they want to support their favorite nonprofit with annual gifts. So let's look at how your RMDs and charitable giving may work for you with some planning. I want you to meet Albert and Shirley here. They're a married couple. They're in the 24% tax bracket. Their standard deduction in 2022 is $25,900. But Albert and Shirley are over 65, so they each get an additional standard deduction, bringing their total standard deduction for the year to roughly $28,700. This means they will receive no tax benefit for any itemized deduction unless their total exceeds that $28,700 mark. So if Albert and Shirley have $15,000 of existing itemized deductions, say from state and local taxes or deductible medical expenses, mortgage interest, what happens tax-wise if they donate $5,000 to charity? They get no federal benefit from that, no federal income tax benefit, that is, from making the charitable contribution, because it does not exceed their $28,700 standard deduction. Now, this is not to say that they shouldn't do it, because they absolutely should. But they should understand that it could also be helping them save on their taxes. So now, if you're over 70 and a half and you have an IRA or an inherited IRA, there is another way to give to charity than simply writing a check. It's called a qualified charitable distribution, or a QCD for short. Let me explain how that works so you can see why a QCD can be so powerful. First, some basic rules. If you are 70 and a half or better, you can make a qualified charitable contribution of up to $100,000 each year from your IRA. If you're married and both of you are 70 and a half or better, and both of you have an IRA, you can each make up to $100,000 qualified charitable contribution from your own IRA. And second, any qualified charitable distributions that you make count towards satisfying your required minimum distribution. That's a big one. However, when you make the distribution, it must go directly from your IRA to a qualified charity. Now, third, and here's the catch, even though you gave to a charity, you get no income tax deduction. So why would you do that? Because when you make a QCD, a qualified charitable distribution, the distribution from the IRA is never counted as income when you compute your taxes. So let's see how that helps out Albert and Shirley. First, let's suppose that Albert and Shirley do what many retirees would do. Albert takes the required minimum distribution of $5,000 at the beginning of the year, and he deposits that into the bank. He's done with his RMD for the year. Now, being charitably inclined, they donate that $5,000 to their favorite 501c3. But let's look a little bit more closely. By virtue of giving to a charity this way, Albert and Shirley's $5,000 charitable contribution will cost them a total of $6,200. So why is that? Because the $5,000 RMD that went into Albert's checking account at the beginning of the year still has a tax cost. Remember that the couple is in the 24% tax bracket, and 24% times 5,000 equals $1,200. So the $1,200 of additional tax that Albert and Shirley must pay when they file their taxes means the total cost of their charitable gift is $5,000 plus $1,200, or $6,200. So remember, the gift did not impact their standard deduction. The RMD behind the gift just added to their income. Now that hurts. So let's see what happens if Albert and Shirley used the QCD to give $5,000 to charity. Instead of requesting a $5,000 distribution from his IRA to go into his bank account, Albert would simply have his IRA custodian transfer the $5,000 RMD directly from his IRA to the charity. This satisfies Albert's yearly RMD because he's over 72. The charity is happy. They receive the $5,000 donation. And Albert and Shirley, they're in a better position now. They still give $5,000 to charity, but even though they receive no deduction for making a contribution, their IRA distribution is now excluded from their tax return. Therefore, they owe no income tax on the $5,000 distribution. Their total cost to give the $5,000 to charity is now $5,000. That's a $1,200 savings over the previous example. And that's simply just by knowing how to use the tax rules to their advantage. And they did it all without ever even getting a tax deduction for it. We all know that charity starts at home. So it is, of course, natural to ask, how does retirement tax planning figure in? And it's a very good question because the government still, of course, wants its share of the tax-deferred assets when you pass away. And like we've seen, how you set things up really matters. And this leads us to our final key number 4. You have to organize your assets for your family's benefit. Now let's talk a little bit about long-term care. Now this is not a long-term care presentation, but believe it or not, there are actually a number of tax breaks associated with long-term care insurance. For example, your long-term care premiums, the premiums that you pay, they may be a deductible medical expense at the federal level and possibly eligible for deductions or credits at the state level. On the other side, if you're now receiving long-term care benefits, in many cases, those benefits are tax-free. For instance, benefits received from a reimbursement style policy, that's the kind where they write a check to whoever's providing the services, those are tax-free. In addition, cash benefit style policies, where they give you a lump sum, those are tax-free if they do not exceed the higher of your actual long-term care costs or the IRS daily limit, which is currently set at $390. So choosing how you pay for your long-term care costs can have a big impact on your estate and your heirs. In recent years, non-traditional long-term care policies that blend together some long-term care insurance and life insurance have become very popular. Often the first inclination of the insured here is to tap the policy to pay for long-term care costs, but that could be a tax mistake. Let's take a look at Florence. She's a widowed woman who qualifies for long-term care benefits, lives at home with income, and she lives at home with in-home care. Her yearly costs are $60,000. Now, Florence's Social Security benefit is $20,000 annually, and that covers her basic expenses. But it does not cover her long-term care costs. She also has a $400,000 IRA and a life insurance policy that has a long-term care rider that will pay $500,000 to Florence's children upon her death. Alternatively, she could use that long-term care benefit attached to the life insurance policy to receive $10,000 per month for long-term care costs. Any amounts used for long-term care will reduce the death benefit of the life insurance. So please note, this is just an example, and it doesn't represent a specific policy, but many life insurance and long-term care hybrid policies, they do work this way. So we're going to look at 2 different scenarios here. The first scenario, Florence is infirmed for 5 years and uses her policy to pay for long-term care expenses. That's what she bought it for, right? So here, Florence pays little to no income tax during this period because she'll have a large deduction for unreimbursed medical expenses. The policy pays $60,000 a year for those 5 years, totaling $300,000. So if Florence were to pass here, her kids will inherit tax-free life insurance of $200,000. That's the remainder of the death benefit from the policy, which was $500,000. 500 minus 300,000 that was paid out. In addition, her children will receive the $400,000 from her IRA, and that money will be fully income taxable to them. Now, in the second scenario, let's suppose that she lives for the same 5 years, but instead she uses her IRA money to pay for the long-term care expenses. Now, Florence still pays minimal income tax per year because she has a high medical expense deduction, and now the kids will inherit the $500,000 of life insurance completely tax-free, as well as the leftover $100,000 of money that was remaining in the IRA. And again, that is fully taxable money. And if we compare the two scenarios, the ultimate net benefit is unknown because it really depends on Florence's children's tax rates. But it's hard to imagine a scenario where paying for care with $300,000 of taxable money with minimal cost to Florence is not a better option than paying for her care with $300,000 of tax-free money. In the second scenario, we're preserving the tax-free money for the heirs and paying the long-term care expenses with Florence's taxable IRA money. Okay, now we're toward the end, and you're probably thinking, my goodness, how in the world will we ever manage this? Well, that's a good question, and it brings us to poll number 3. How confident are you in your process for reducing income taxes during retirement? A, I don't have a process, I'm not confident in my process, or my taxes couldn't get any lower. All right. Great. Okay. Thank you for participating, everybody. And no surprise, not very many people said that their taxes couldn't get any lower. Most people said that they either don't have a process or they're not very confident in it. So let's quickly summarize what we've learned here today. We started with a problem. Retirees will often pay more in taxes than expected because of the confusing system that treats various types of income differently, and it contains hidden taxes and penalties. And since then, we learned that during pre-retirement, we saw the importance of understanding the after-tax value of your retirement savings before you retire. And we also saw that in those pre-retirement years, it's critical to consider your tax-deferred savings, and you may want to start taking advantage of funding Roth IRA accounts to fill up your tax brackets. We also looked at Social Security and taxes during your early retirement years. We saw that Medicare has a tax-like structure built in that can push you off of the IRMA cliff. We also saw the importance of signing up for Medicare on time. And starting in mid-retirement, you're going to be confronted with making required minimum distributions. Now, we've seen the importance of planning your income needs before then and for the tax issues involved. Lastly, we saw the importance of setting up your assets and managing them during the later years of retirement so that you can preserve the most for your heirs and leave them with the most tax flexibility. And all those items together lead us to this obvious solution to our original problem. Because your tax exposure will change throughout retirement, you need a strategy that will anticipate how and when you tap assets to cover your personal expenses, that understands the range of taxes you will face at various stages in your life, and that manages your actions so that you pay the lowest tax rate possible. By attending this presentation, you've signaled to us that you're preparing to leave the accumulation phase of your life. It's where you're saving for retirement, and move into the distribution phase. That's where you start spending your retirement assets. And we've seen that this distribution phase is at least as complicated as working and collecting a paycheck. Managing your tax rate throughout the 30 or 40 years of retirement is part of the challenge of retirement planning. And we've seen some of the costs of mistakes made before and after retirement. Naturally, we all want to be efficient with our savings. There are many strategies to reduce your tax burden, but as with many things in life, this takes education, planning, and advice. We know it's a lot to think about, so we here at Advisory Group West, we would like to help you get started by creating a retirement tax planning strategy. We want to invite you to part 2 of today's presentation. It's a complimentary 1-hour retirement planning overview conversation. This will be a one-on-one conversation where we can talk privately about your retirement, your savings needs, and the role that taxes will play. During that meeting, we'll identify where you and your family stand in preparation for retirement, review your timelines, identify key retirement planning and tax issues that you need to anticipate. And coming out of that meeting, we can act as your resource to help you find the right people to assist you with specific tax advice, if it need be. Naturally, we can help you with the key financial planning and investment advice that relates specifically to your personal situation. One thing that we are confident of, even if we never end up working together, when you leave that meeting, you will be better informed about your retirement planning needs and what to consider doing next. We want you to be prepared and organized for this aspect of your life so that you and your family can have peace of mind, knowing that you have a plan for making the most of your retirement. So if you could, please complete the meeting request form now to schedule your one-on-one conversation. And if you're not sure you're quite ready for that, don't know if you can take that leap just yet, you also have the option to schedule a quick 30-minute phone call or a Zoom where we can just get to know each other a little bit better first. And I'll give everybody 30 seconds to do this, and then we'll jump into your questions. Okay, that's just about 30 seconds. Thank you, everybody. I am being told by staff that we do have time for a couple of questions, so that's great. They've lined up a few for me here. Question number 1. Is there anything that I don't have to pay taxes on? We hear that one a lot. Off the top of my head, I can definitely think of a few. Life insurance proceeds to a beneficiary, those are tax-free. Roth IRA withdrawals, assuming you've met both of the qualifications, which are you have to be at least 59 and a half, and the account has been open for at least 5 years. Financial gifts given to you, usually only the giver may owe tax on the gift. And any HSA money, health savings account money, that you use for qualified medical expenses. Now, keep in mind, you may still need to report some of these items on your tax return. So even if you're not being taxed on them, you still need to include them. Question number 2, thank you. I inherited an IRA from my 83-year-old mother this year. I'm sorry to hear that. She had not taken her RMD yet. Do I need to take one for the year, or does her estate take it? Okay, this is a very common question. Once a parent passes, you need to open what's called a BDA IRA. That stands for a beneficiary designated account. That IRA money now fully belongs to you and is tied to your Social Security number. So yes, you will need to satisfy her RMD for the year, and yes, it will be fully taxable at your tax rate. Okay, and see our third question. I am 68 years old with 4 adult children and planning to retire from LA County soon. I have a large retirement account, over $1 million. Should I make my trust the beneficiary? First of all, congratulations on your retirement and for saving so much. So the answer to this question really depends on you and your kids. If you're trying to protect somebody, maybe somebody with special needs, or if you're worried about one of your kids squandering the money, then it may be worth talking to an estate attorney. If not, you may be inviting unneeded complexity and taxation. That is, if you don't need to protect someone. If the trust is not set up properly, you may end up forcing what's called the 5-year rule into effect, where all of that money needs to be paid out, fully taxable within 5 years. And that's on an accelerated tax table that's specific to trusts. Now, if you don't have special reasons to put the money into a trust, you may want to just list the 4 kids as beneficiaries on your retirement plan. Then they can just open up their own IRAs and inherit the money. They don't have to be equal beneficiaries either. You could make it 10, 10, 10, 70 if you wanted to. So, and, okay. I'm sorry, staff is now telling me that it is time to wrap up. It looks like we're out of time. So I want to thank everyone who participated. If we didn't get to your questions, please know that we will follow up with you in person. Thank you very much for coming out today. We look forward to being of service to you. Have a great day.